Hello and welcome to Calmvestor podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. Today, we are diving into a subtle yet powerful distinction, the difference between risk and uncertainty in the financial markets. Many people use these terms interchangeably, but understanding their differences can profoundly impact your investment decisions and overall financial well-being. Why is this distinction so vital? Consider an investor who, trying to avoid all risk, keeps all their money in cash. They feel secure, but over time, inflation erodes the purchasing power of their savings. They have avoided market risk, but succumb to the uncertainty of currency devaluation. A silent thief. Remember 2008? The U.S. stock market plummeted by 37%. A staggering 44% of Americans vowed never to invest in stocks again. They were reacting not just to the inherent risk of stocks, but to the overwhelming uncertainty of a major financial crisis. Have you ever felt that gut-wrenching anxiety when markets become wildly unpredictable, making you want to sell everything? Is that feeling a response to a calculated risk, or are you grappling with something far bigger, something more nebulous? As Warren Buffett wisely said, we often pay a high price for certainty. Think about the COVID-19 pandemic, a classic example of uncertainty. No one could predict its exact timing or impact. This is different from the risk that a specific stock you own might fall because the company underperforms, which is a somewhat foreseeable risk. So let us clearly define these terms. Risk in finance refers to the potential for an undesirable outcome where the probability of that outcome can be estimated or calculated, often based on historical data or financial models. Examples of financial risks include interest rate risk, where changing rates affect bond values, or credit risk, the chance a borrower defaults. Even the volatility of a specific stock, often measured by its beta, is a form of quantifiable risk. Burton G. Malkiel noted, investment risk is essentially the chance that your expected returns do not materialize. Uncertainty, on the other hand, deals with events or outcomes whose probabilities we cannot reliably foresee or measure. These are the true, unknown unknowns. Uncertainty often arises from structural shifts in the economy, groundbreaking disruptive technologies, sudden geopolitical crises, or global events like pandemics. These are situations where past data offers little guidance. The economist Frank Knight was one of the first to clearly distinguish these. He stated that risk is measurable, while uncertainty is immeasurable. This core difference is crucial for investors. Because risk is measurable, it can often be managed through strategies like diversification, asset allocation, or even specific financial instruments like insurance. Uncertainty, however, demands a different approach, building resilience, maintaining flexibility, and preparing for a range of unplannable scenarios. Consider this analogy. Driving your car every day carries a calculable risk of an accident, which you can manage with insurance. But a meteorite suddenly falling from the sky and hitting your car? That is a profound, uninsurable uncertainty. Confusing these two concepts leads to significant investment errors. One common pitfall is over-conservatism. Investors might treat all market volatility as an unacceptable risk, causing them to hoard cash or stick to extremely low-yield assets, ultimately failing to meet their long-term financial goals. Then there is emotional investing. When true uncertainty strikes, like a sudden market crash, many investors panic. They sell off perfectly good assets at low prices because they perceive everything as too risky, failing to distinguish temporary market turmoil from the fundamental risk of their holdings. Anthony Robbins insightfully points out that many people wish to avoid financial risk primarily because the feeling of uncertainty makes them deeply insecure. This insecurity can drive irrational decisions. Another issue is misjudging control. We might try to predict the inherently unpredictable, focusing our energy on forecasting uncertainty instead of managing the risks that are actually within our sphere of influence. This confusion also means missing significant opportunities. Times of great uncertainty can also birth incredible chances for growth and innovation. However, fear often keeps people on the sidelines. During the 2008 crisis, many sold shares in strong, resilient companies simply due to the market-wide uncertainty. So why do we fall into this trap of confusing risk with uncertainty? Behavioral psychology offers many answers. Loss aversion is a key factor. The psychological pain of losing money is far more powerful than the pleasure of gaining an equivalent amount. This makes us overreact to negative news and uncertain conditions. Herding behavior also plays a part. We see others panicking or making rash decisions, and we tend to follow the crowd without independent thought. Then there is overconfidence, the belief that we can somehow predict or control uncertain events, which is a common bias among investors. A lack of deep financial knowledge contributes too. Not fully understanding different asset classes or how they behave under various market conditions can lead to misinterpretations. As Robert G. Hagstrom observed, an individual's risk tolerance is often emotion-based and, therefore, can shift dramatically with changing circumstances. Media influence can exacerbate these feelings. News outlets often focus on sensational, negative headlines, which can amplify anxiety and the sense of pervasive uncertainty. And of course, the financial market, by its very nature, contains both measurable risks and unpredictable uncertainties. Jim Rohn said, "If you are not willing to risk, you cannot grow." This wisdom applies to how we must learn to face both calculable risks and the inherent uncertainties of life and markets. How then can we navigate this complex landscape? First, let us talk about managing measurable risk. This starts with clearly defining your personal risk appetite. What level of volatility are you comfortable with to achieve your financial goals? Burton G. Malkiel highlighted that the risks you can prudently accept depend significantly on your overall financial situation, including your income sources and your investment timeline. The next crucial step is diversification. Diversify, diversify, diversify. As Anthony Robbins describes it, diversification is like an insurance policy that can help reduce your overall risk and potentially increase your returns without necessarily costing you more. Spread your investments across various asset classes like stocks, bonds, real estate, and commodities. Investing for the long term is also key. Time has a wonderful way of smoothing out short-term market jitters and allowing fundamentally sound investments to grow. And critically, only invest in what you truly understand. Know the risks involved before you commit your capital. Benjamin Graham, the father of value investing, taught that successful investing is about managing risk, not avoiding it. For instance, instead of putting all your eggs in one basket, like investing in only one company or sector, diversify to cushion potential blows. Now, let us turn to dealing with uncertainty, those elements that are harder to control. The first principle here is to accept its existence. You cannot eliminate uncertainty, but you can build flexibility and resilience to navigate it. A practical step is to create and maintain an emergency fund. Having 3 to 6 months, or even more, of living expenses in accessible cash can prevent you from being forced to sell your investments at unfavorable prices during unexpected personal events or market turmoil driven by uncertainty. Anthony Robbins advises to position yourself conservatively, so you are not forced to sell when prices are low. This financial buffer gives you peace of mind and staying power. Maintain a flexible and learning mindset. The world is constantly changing, and so are financial markets. Be prepared to adapt your strategies and continuously educate yourself. Focus on what you can control: your reactions, your financial plan, and your knowledge. Employ a margin of safety, a concept popularized by Benjamin Graham. This means buying assets at prices significantly below their estimated intrinsic value. This buffer can help protect you against unforeseen negative developments or errors in your own judgment. Use scenario thinking. Mentally walk through various potential worst-case scenarios and consider how you would respond. This preparation can reduce panic and improve decision-making if such events actually occur. Nassim Nicholas Taleb, author of The Black Swan, famously said, "You cannot predict black swans, but you can build robustness against them." This emphasizes preparing for the impact of rare, high-impact, uncertain events. Before making an investment, ask yourself, if the market were to drop 30% due to an unforeseen global event, what would happen to my portfolio? Would I have enough to live on? Would I be forced to panic sell? Answering these questions honestly is crucial. To conclude, understanding the difference between risk and uncertainty is not about fostering fear. It is about equipping yourself with the wisdom, tools, and confidence to navigate the financial world more effectively. Let us recap the essence. Risk can often be identified, measured, and managed with specific strategies. Uncertainty, however, requires a mindset of preparedness, adaptability, and resilience. Smart investing is not about trying to achieve zero risk or completely avoid uncertainty. That is impossible. It is about understanding these forces, assessing them correctly, and implementing appropriate strategies for your unique situation. I encourage you to take some time after this podcast to reevaluate how you perceive risk and uncertainty in your own financial life. Are your decisions driven by clarity or by confusion between these two? Commit to continuous learning in personal finance. Build a robust financial plan that not only addresses identifiable risks, but also incorporates buffers and strategies for dealing with the unpredictable nature of uncertainty. Peter Lynch once remarked, "In business, the worst things often happen at the same time, but so do the best." This suggests that both significant risks and profound opportunities can emerge from periods of uncertainty. Imagine this knowledge not as a burden, but as a better compass and a more complete toolkit for your investment journey, allowing you to navigate with more confidence and less fear, rather than wandering in a fog. So, here is a thought to take with you. Reflect on a recent, significant financial decision you made. Was it primarily driven by a fear of calculable, manageable risk, or by a more amorphous fear of the unknown, of uncertainty? Perhaps now is a good time to start learning more about building a diversified investment portfolio and establishing a solid emergency fund. These are foundational steps to confidently face both risk and uncertainty. If you found this discussion valuable, please consider sharing this podcast episode with friends or family who you think might also be grappling with these important financial concepts. Thanks for listening. If you found this content valuable, do not forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.